We pick around 40 growth stocks from the areas of the world where we think we have the most opportunity to make good money for our clients. And we tend, as a portfolio, always to have a strong focus on the American market, particularly the technology sector, and particularly the medical technology sector, and finally the service sector. And these are all areas that the Americans do extremely well. They're very innovative, hard-working, inventive people. There's a lot of risk capital available in America, and so that seems to us to be an area of great strength. And actually, over the last 10 years, technology and medical technology have far outperformed the broad market in America. And so we will continue to focus on those areas. The second key area for us is Asia and emerging markets. And again, remember, we are growth stock investors, but the most consistent element of growth in Asia is the consumer. There are a lot of people in Asia, the demographics are right, a lot of young people, they work hard, they save hard, they want all the things that we take for granted. They want to go on holiday, they want to educate their children better, they want better healthcare, and at the more basic level, they want a motorcycle, they want a car, they want better food and drink, and so forth. And these are very, very strong underlying dynamics. And if you pick the right companies which are catering to those needs and those desires, in the medium to long term, you make extremely good returns. And then the final element is the European companies. And again, it's a bit like America. We select companies rather than countries. And actually, we tend to focus on industrials and, again, innovation and technology, things that a lot of European companies are extremely good at. So 40 stocks, 15% earnings growth, focused on absolute return. We're not interested in relative to the index. We want to make people money. Well, the answer is it was a difficult year, but it was very much a year of two halves. We did very well in the first half, and then we had, like everybody, a very tough time in the last quarter of the year. The markets vary, obviously, around the world, and we had last year about 60% of the fund committed to America, and the American market was down about 5 or 6% for the year. The Chinese market, on the other hand, was down over 20% for the year, but luckily we had very little exposure there. So the key element of running a global fund is to try to avoid the disasters and to have your money, your clients' money, committed to areas where things are not so bad. And the other thing to say is that whereas our Asian stocks and our Asian focus was not helpful last year, a lot of the stocks continued to trade extremely well and to generate very good profits and very good results. But at the end of the day, you're buying shares in a company. You're not buying the company. And so the company can be trading very well, but actually if investors don't want it, the share price tends to go down, but the profits are still going up. That's what matters in the medium term. And so at the moment, our emerging markets and Asian companies are looking incredibly good value. Profits have come up, stock prices come down. In the end, the dynamic asserts itself where the profits of the company tend to drive the share price. So our strategy has not changed. We are focusing, as I say, on Europe, mid-cap growth companies. We're focusing on Asian consumer companies. We're focusing on American technology companies and American service companies. And these are all consistently good growth areas of opportunity for investors. I think the first element of that is, as I've already said in the last question, actually, we are very positive about emerging markets in Asia. They had a tough time in 2018. As I say, our stocks, our portfolio of Asian and emerging market stocks looks very good value at the moment, very cheap. And I think that last time it's never in fact looked cheaper. And last time it was at about this level, we had a fantastic year in 2017. So I'm very positive about that. And I'm actually extending our positions in Asia and emerging markets. I'm not that positive about Europe. Most European countries seem to be flirting with either zero growth or into recession. So our European weighting is coming down. And the great thing about the American market is that there are always incredibly good opportunities as a growth investor. And it's like a sort of market where you could always pick interesting investment stocks. And we still have about 60% of the fund in America. We are pushing it up to about 25% in Asia, which leaves about 10 or 15% for Europe and other areas. So we're very optimistic. Yeah.